Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louie, and I'm excited to have you join us today. We're starting off with a fascinating story that highlights the innovative ways companies are working to reduce their carbon footprint while also generating revenue. You might have heard about the concept of carbon capture and utilization, but today we're going to explore how companies are taking concrete steps, literally, to turn carbon dioxide into a valuable resource. From using CO2 to create greener building materials to converting it into products like aviation fuel and fertilizer, the possibilities are vast. We'll be looking at examples of companies like Carbon Upcycling and Carbocrete, which are pioneering new technologies to make this vision a reality. Now, I know some of you might be thinking, but isn't carbon capture just a costly and complicated process? And yes, it's true that traditional storage methods can be expensive and energy-intensive. However, the benefits of reducing greenhouse gas emissions and creating new revenue streams are undeniable. As we delve into this topic, we'll also be discussing the challenges and limitations of carbon utilization, including the need for more support and resources to deploy these technologies on a larger scale. We'll hear from experts like Dave Sawyer, principal economist at the Canadian Climate Institute, who will provide insights into the role of carbon utilization in the broader context of emissions reduction. So, let's take a closer look at this exciting development and what it could mean for investors and the environment. It's a story that highlights the power of innovation and the potential for companies to drive positive change while also generating profits. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and markets, where the stakes are high and the players are always on the move. Today, we're looking at a story that's making waves in the Indian financial sector. Asset Reconstruction Company Ltd, or ARSL for short, is set to make history with its initial public offering, marking the first time a bad loan aggregator has gone public in India. Now, let's take a closer look at what this means. ARSL, backed by heavy hitters like State Bank of India and Avenue Capital Group, is looking to sell off a significant stake, 32.57% to be exact, through its IPO. This move will not only bring in fresh capital, but also provide an exit opportunity for some of its existing investors. Avenue Capital Group, for instance, will be reducing its holding from 69.73% to 48.57%, while SBI will trim its stake from 19.95% to 13.96%. The numbers are certainly impressive, with ARSL reporting a net profit of Rs 355.31 crore on revenue from operations of Rs 596.42 crore in the fiscal year ended March 25. The company has acquired total principal debt of Rs 72,657.3 crore at a cost of Rs 38,155.63 crore and made recoveries worth Rs 28,459.7 crore. But what does this mean for investors and the broader market? On one hand, ARSL's IPO could provide a much-needed boost to the Indian financial sector, which has been dealing with its fair share of challenges in recent time. On the other hand, some experts might argue that the timing of the IPO is not ideal, given the current market volatility. As always, we want to hear from you, our listeners. What are your thoughts on ARSL's IPO? Do you think it's a smart move, or are there potential risks that investors should be aware of? Share your opinions with us on social media using the hashtag #Riskwiser Zone. And that's all for this segment of the show. We'll continue to keep a close eye on developments in the Indian financial sector and bring you updates as more information becomes available. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up another exciting episode, and I'm glad you're still with us. As we dive into our closing segment, let's take a look at some of the top stories making waves in the financial world. It seems like Apple is once again the center of attention, with multiple institutional investors adjusting their positions in the tech giant. Runnymede Capital Advisors Inc., for instance, reduced its stake in Apple by 1.8% during the first quarter, while Tanglewood Legacy Advisors, LLC, increased its holdings by 2.5%. WG Holdings LP also trimmed its position by 1.6%, and Sawgrass Asset Management, LLC, sold off 12,798 shares. But that's not all. Spinnaker Investment Group, LLC, decreased its Apple holdings by 3.1%, and Diversified Portfolios Incorporated cut its stake by a significant 27.3%. It's clear that investors are reevaluating their strategies when it comes to this tech behemoth. In other news, we've seen a slew of price target increases for various companies. Lam Research, for example, had its price target lifted to $125 BTD count. Meanwhile, Apple itself received a boost from multiple analysts, with some setting their targets as high as $150. Now, I know what you're thinking. What does this all mean for the average investor? Well, it's essential to remember that these movements are just a normal part of market fluctuations. As always, it's crucial to do your own research and not make any rash decisions based on short-term trends. As we close out today's episode, I want to emphasize the importance of staying informed, but also being cautious. It's easy to get caught up in the excitement of market movements, but it's essential to prioritize your long-term financial goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.